Hello, and welcome to the 2025 forecast for where mortgage rates and real estate values will go. My name is Ricky Walters. I'm a certified mortgage advisor with Landmark Lending and your mortgage wise guy.
He's the mortgage wise guy, wise guy.
All right, let's first take a look back a year ago and what we projected and how it turned out. Home price appreciation was projected between 4.5% to 5%. Nationally, actually, it came in at 4.5%, so right at the lower end. The 10-year Treasury yield was projected between 3 to 4.4%, actually came in a little higher, between 3.6 to 4.7. And the 30-year fixed we projected between the mid fives to high sixes, and under six would unlock move up buyers. That actually happened, but like the 10-year Treasury, we were a little optimistic. It went from the high fives to the low sevens. And why did that happen? Let's take a quick look at that. Why did we miss on the 10-year Treasury yield and mortgage rates? Well, the number one reason is the BLS job reports, which monthly we get from the BLS, Bureau of Labor Statistics, the first Friday of every month, the jobs gained or lost, and the survey of 670,000 businesses, which seems like a lot, said we gained 2.5 million jobs over the last year. But if we compare that to another government report, government agency called the QCEW, that stands for Quarterly Census of Employment and Wages, they revised that 6 to 9 months after the fact and said only half of those jobs were actually created. So that is an overstatement of over 100,000 jobs per month. Now, had that come in real time every month, we would have seen the Fed be more aggressive, and we would have certainly seen mortgage rates come down because it's anti-inflationary to have higher unemployment. But when it comes in 6 to 9 months later, it's old news. And so it's not given the same importance and weight in the market with the traders for bonds and mortgage-backed securities. All right, let's take a look forward with the 2020 forecast for what the Fed is going to do. They have a dual mandate. Do you know what that is? Two things. Price stability, meaning they want to get inflation down to 2.0% on core personal consumption expenditures. That's what PCE stands for, their favorite measure of inflation. Their second part of that mandate is what we were just talking about, trying to keep in unemployment low, avoid a recession from job losses and too high unemployment. This is the dot plot that the Fed themselves give, the last one they gave in December of 24, and each dot represents an individual Fed member. So the great majority of them, you can see the medium forecast is that they project will go down 50 basis points from where we are currently to 3.875. Just a couple months ago, they were projecting a 100 basis point cut because the job numbers, unemployment came down slightly towards the end of the year and inflation was a little hotter, the way they read it anyway, than what they anticipated. So if we look at what they're forecasting, the Fed that is, they think that unemployment will be between 4.2 to 4.5% this year. The great majority of them think it's going to be in the range of 4.2 to 4.3, 14 of the members. And another five think it's going to get a little higher than that. And it would surprise them significantly, all of them, if we went up 0.5% on unemployment this year. Well, we can see that the University of Michigan survey of consumer expectations, a lot of the public thinks that unemployment is going up and up. This is the gap between rising unemployment and declining unemployment. And you see that over the last 3 months, that's risen significantly as they've surveyed the consumers and individual Americans. This is the largest gap actually since December of 2007, right before the Great Recession of 2008 and early January 2001, right before the recession we had in 2001, 2002. So is the Fed too restrictive, which means are they keeping rates too high? Well, I think they are. We first have to look at what the Fed calls their neutral rate. They calculate that from taking where core PCE is in the moment at 2.8%. And then they add this margin called R star from their calculations. And we get that the neutral rate they think is 3.5% essentially. But currently, the federal funds rate's 4.375. So to get down to 3.5%, we're about 8 to 9 tenths above where neutral would be. However, the Fed is forecasting that PCE, personal consumption expenditures, is going to go down this year to 2.5%, lower inflation. Well, that's going to lower their projection then above neutral. We'd be a little bit like a 1 1/8 above where neutral is. We may not get there all the way this year, but I do believe we will see the Fed move. And here's the projection from where they are currently at basically 4.25 down to 3.25. So a full percent. I think they're going to go back to their previous projection when they see the numbers come in for higher unemployment and lower inflation, which we're getting ready to talk about in a moment. So the search for yield, why is the 10-year yield so high? That's the benchmark yield. Well, if you compare to money market rates, which an average rate you can get at the moment from most banks is about 4.5% with no risk. There's a little bit more risk for the 10-year treasury, the benchmark for mortgage rates. So why would you take the risk if there's not that much difference in the rate of return? However, we're forecasting, at least banks and the Fed are forecasting lower inflation and lower money market rates as they bring the prime rate down. So that's going to make the 10-year treasury trade a lot more attractive. And as they do that, that will bring mortgage rates lower as well. So you can see the transfer of money from money markets into a little bit riskier 10-year treasury purchase. Love this slide because it shows what inflation truly is, which is too many dollars chasing too few goods. If you translate that to the housing market, it's too many buyers with too few homes for sale. And that's putting upward pressure or inflation on the cost of homes and home appreciation. Okay, let's talk about inflation and core PCE. Why is it significantly overstated? Well, the last report we got in November of 2024 was 2.8%. It came out at the end of December. The next one we get for December will come out at the end of January. Shelter is 18% of that whole report. And as measured inside of this report, it's 4.8% increasing in rents according to the core PCE shelter component. But they are looking backwards, in other words, averaging the whole last year instead of looking in real time, which is what CoreLogic, a very reliable aggregator of what the cost of rents are and the rate of rent increases are, which they say it's only 1.7%. So if we subtract that out, we see there's a 3.1% overstatement in rents that's actually occurring in the market today. And if we then apply that to the 18% or multiply that by the 18% that it is in core, that results in an overstatement of 0.5%. So in other words, the current core, if we're looking in real time, should actually be only 2.3%, very close to the Fed's target of 2.0 on core PCE. We can see, of course, that the trend is lower. And like I said, if the core PCE is averaging all of this instead of looking in real time, like CoreLogic, this number average is going to be much higher, and that's why there's a lag in that reading. This is showing the upcoming replacements every month that we get the core PCE reading. It's replacing one from a year ago with the most recent month. So we believe that the higher numbers that we're going to start to see in the January report, which actually we won't get till the end of February, that's where we're going to see some significant movement in lower inflation numbers. And that's going to then push mortgage rates lower, the 10-year treasury lower, and make consumers a lot happier. So let's take a look at inflation in the current moment and then cumulative over time. We can certainly see that rarely do we see an actual dip in inflation where inflation is below zero or negative. We see that rarely during a recession, these shaded areas in the 2008 Great Recession, as well as the 2020 and 21 COVID recession, we saw a slight dip. But other than that, it just keeps going up over time. Okay, so inflation forecast. Core PCE inflation I believe is going to go from where it is currently down from 2.8% to the range of 2.1 to 2.2%. Let's next look at labor or the unemployment that we're measuring and that the Fed looks at so carefully as part of their dual mandate. All right, this is the unemployment rate over the last 2 years, over 23 and 24, and you can see absolutely that the trend is higher. However, we dipped a little bit. It broke the trend at the end for some seasonal adjustments, and so that's actually why interest rates went up towards the end of 2024 after the Fed started cutting rates. The median duration or length of time, if you do get unemployed, if you quit, change jobs, and don't already have another job, or you're fired from your job, it's taking a longer period of time, 21% increase in the length of time for you to actually get the next job. So that's pointing to a worse unemployment picture. Adding to that are all these chain stores. You can see the number of chain stores that have closed in the last year as opposed to up 70% compared to 2023. And I've already seen some headlines of more stores closing in different chains here at the beginning of 2025. All right, at the other end of the spectrum then is job openings and labor turnover survey, JOLTS. And this is showing us the hiring side of the equation. So clearly the trend is in the opposite direction since the beginning of 2022, 23 and 24. Now we've gone from 12 million openings to 7.7, significant decline, and even that is not telling the whole story because job openings are gathered from each individual state. And as we know, since COVID, we've got lots and lots of remote jobs, not all of them certainly, but many remote jobs. And with one remote job posting, it can be posted in multiple states, so making this number appear much higher than it actually is. My guess is it's below 7 and probably even below 6 million in true job openings if you take out the duplicate postings in the multiple states. All right, so our forecast for the labor market and unemployment is for the unemployment rate to go up from where it is currently into the range of 4.5 to 4.6%. And then we're going to look next. What everybody really wants to know, I'm sure, is the forecast of mortgage rates over the next year, over 2025. So where could they go in the next 6 months? Based on the projections of higher unemployment and lower inflation, I believe the 10-year Treasury is poised to decrease back down to 3.6%. That doesn't seem like much of a stretch because we were just there 3 to 4 months ago in September and October. And as I said, only because of seasonal adjustments and inflation not being caught up on the true rents of where we are, we've seen higher rates towards the end of 2024. But this target, we should be hitting that again, I believe, in the next 6 months. All right, adding to this picture of potential lower mortgage rates is what we call the spread between the normal historical spread between the 10-year Treasury yield. Currently, that's at 4.6%. And you can see the current spread here at this end of the graph is 2.5. So you had 2.5 to 4.6, and you're at basically the low sevens. That's where most of the mortgage rates are for a 30-year fixed right now. But the normal spread is only 1.5 to 2. We see some wild swings after COVID, but if we get back to the normal historical spread, which I think is highly likely, we're going to see that helping to bring mortgage rates down as well. So the spread between the 10-year Treasury and the 30-year fix should continue to narrow to more historical norms. And that's going to then help us in the next 6 months to get to 3.6, right? We narrow the spread, and then the mortgage rates for 30-year fixed are in the high fives. And if it narrows even further to that 2% spread, which is more historically normal, we could even see mid fives later this year, very likely. All right. Lastly, we're going to look at the 2025 forecast for real estate. If you own a home, good for you because you have lots of equity. The average equity per household is $407,000, and compared to renters, zero, no equity. This is a good reason just by itself in this slide to tell you if you're not owning a home, you need to be thinking about it and doing everything you can because it's the best way to build generational wealth for you and your family. Some people even are so far ahead of the game that they have no mortgages. Their mortgages paid off. Obviously, they have more equity. I'm here in the Northern Cal Bay Area, and these numbers are actually very low for most of the houses here because the values are even higher with more equity. All right. Demographics is destiny. What does this tell us? Well, we're looking back at the generations who currently own homes and will be owning homes. So, boomers, they're the oldest generation. They own almost three-quarters of them own a home. Gen X's are behind. And then we look at the millennials. There's 73 million total millennials in our country today. Median age is 35 years old, and the home ownership rate is 45%. So if we lower that and we look at just the median age of 30, that'd be about a 40 million total. Their home ownership rate would be 33. Why are we doing that? To compare to the previous generations, Gen X and Boomers, of their home ownership rates when they were 30 and 40 years old. So in the next 10 years, the home ownership rate for millennials should go up to about 55%, or bringing another 8.5 million families needing a home into the market. And then if we look at Gen Z, the youngest generation, their only median age is 20 years old. Their homeownership rate is only 8%. They're just getting started. But as they go the next 10 years plus, that homeownership rate should jump to 33%, following the previous generations. So adding all this together and figuring, of course, some loss of homeowners in the millennials, excuse me, in the Gen Xers and the boomers, we're going to need about 20 million more homes. But where there's no chance we're going to have that many more available. What does that tell us? Supply and demand. Well, the media has made a big deal recently of a little bit more active listings in 2024 than there were in 2023. Seems like a substantial increase when you first glance at it. But if we look pre-COVID, the COVID recession being here, we see the actual range, kind of historical normal range, is active listings in the neighborhood of 1.2 million versus where we are today at maybe 900,000. So that's a decline actually of 21%. And then we add on to that, the population has grown since 2018 to today by about 12 million people. So that's adding even more upward pressure to prices and the supply and demand and equity. Speaking of supply and demand, here's the average demand that we've been seeing going back for the last 4 to 5 years, roughly in the range of 1.9 million homes in demand, with some swings certainly for COVID and before and after COVID. And then we compare that, excuse me, to supply, and we see there's a disparity here of about 600,000 homes that we don't have enough for the demand to meet the demand in the average range. Again, supply and demand is going to cause inflation and home appreciation. And this is the reason why home prices have continued to rise in the last several years, even though we've seen the highest interest rate environment for mortgages in the 7 even to 8% range, and we're still seeing home appreciation in the 4 to 6% range. All right, so our forecast then for homeowners is 4.1% appreciation. If you don't have a home, great reason to buy a home, because you're leveraging your financing. Imagine if you bought a $1 million home, you're expecting a $41,000 increase in your home equity in just 1 year, but you only put 50,000 down, a 5% down, which is definitely possible for most folks. And that would mean you'd almost doubled your rate of return of investment of 50,000 to another 41,000 in 1 year. And cumulatively over the next 5 years, the projection is if you bought a $1 million home, you would gain 300,000 to 350,000. That's huge in just 5 years. This is why it's so important to get into the game, buy a home as soon as you can. All right, let's recap all of these things. Home price appreciation to be in the 4 to 4.5% range. Core PCE to come down from 2.8 into the range of 2.1 to 2.2% for this year. Unemployment to go up from currently at 4.1 actually to the 4.5 to 4.6% range. And because of that, I believe the Fed will be more aggressive and go back to their previous projection a couple months ago and cut a full 100 basis points, maybe even more in 2025. This would then help mortgage rates to decline from where they currently are in the sevens down to the range of 5.75 to 6%. All right. If you need an illustration of how much equity and how much net worth you can gain by buying a home, I'm happy to send this to you. Just reach out and ask me, and I'll take a look at your current rent and the home price range you're looking to buy. In this illustration, someone bought a $1.2 million home in my market in Livermore, California. And in just 10 years, they're projected to gain $800,000 in net worth over that time period. And this factors in the cost of buying, the cost of selling, the tax benefit compared to rent. I'd love to send you this so you can see the numbers and evaluate this for yourself. Lastly, the National Association of Realtors did an exhaustive study. Pardon me. Did an exhaustive study over the last number of years and found that 40 times greater net worth than renters. That's why you want to move from being a renter, and you don't want to wait. You can always, even though rates are high, don't wait. The longer you wait, the more competition, especially with rates going to be coming down. It's going to be pushing the price of houses even higher. That's why I like to say, and I'm certainly not the only one who says it, marry the home, date the rate, get that home now. You can always refinance that rate in the future. And if you're renting, then divorce the landlord. This is Ricky Walters, your certified mortgage advisor with Landmark Lending and your Mortgage Wise Guy.
He's the mortgage wise guy, wise guy.
All right. Thank you so much for coming and listening, and I hope you have a great day.